Okay, all right. Welcome on everybody. There's more folks joining as we speak, but we'll go ahead and get started here in the interest of time and to ensure that we're respectful of everyone's time who has made it already. Let me turn on my video as well here. Okay, can you see me, Byron? All right, fantastic. Okay, so like I said, welcome everybody. So today is Friday, March 4th, 2022. Just a real quick high level, this is our monthly webinar. Primarily, we do this webinar for our mastermind members. However, we open it up to other folks who we invite and are more than welcome to join, especially when we talk about very important topics related to capital raising or really just commercial real estate in general. But today's topic is in fact about capital raising. And because we've moved it to Friday, we're calling it Friday Fun Facts. We used to do this on Saturday and called it Saturday School. And so there's been an evolution in how we've been doing these webinars. And so hopefully by doing it on Fridays over the lunch hour towards the end of the week, we'll be able to provide a more accommodating time for more folks. And so again, welcome on to those who are joining right now. Happy to have you. So yeah, capital raising done right. Our guest speaker today is Byron Elliot. He's the founding partner at Three Pillars. They specialize in securities law, and so really excited to have him on board for this presentation today. My business partner, Michael Uperio, is on the line as well. If you can advance to the next slide, I'll go through just a couple of items. So Redeem Investments is the name of our company. We specialize in a couple of different areas, but before I get there, let's go through a couple of things. If you can go to the next slide, Michael. Just a quick disclaimer: I'm not an attorney. That's Byron's job. He's great at what he does. I'm just a real estate guy, not a licensed investment advisor. I'm not an accountant. The information we're sharing here really is for educational purposes only, and in an effort to help educate other people who are aspiring to do some of the things that we're doing. So we're excited to be able to present in this forum. We do specialize in three areas of real estate. The Redeem Realty Solutions, our residential arm. The commercial real estate piece is exactly what we're talking about in terms of value-add apartment buildings. And then we also do land development, specifically with regards to renewable energy. And in that case, we really just serve as the capital partners to our development partners who we provide short-term bridge debt to in the course of building out utility scale renewable energy projects. Next. So as I mentioned earlier, we provide this really for our mastermind members, and there's a couple of different ways to structure mastermind. Just real quick, how we do ours. Ours is basically a joint venture partnership program where we enable members of our group to co-GP on deals alongside us. It gives them access to different resources and documents, training, etc. We host meetings and events just like this throughout the course of the year. And ultimately just provide them with everything that they need to be able to ultimately venture out on their own. Michael and I supported recently a mastermind member who struck out on his own and was able to source a 31 unit deal in Chattanooga, and so we were happy to support him in doing that. As far as who members are in our group, you can just see the list here, mostly Service Academy grads, but also other folks within our respective networks that we've been able to include into our group. So next. If anybody's interested in participating in that, you can go to our website. You can send us an email or really just engage with us on the website. As I mentioned, this is sort of not for everybody. This is definitely for those who are aspiring to be general partners in syndication deals like we're talking about today. And ultimately, we do have limited partner positions for those who are interested in simply being a limited partner alongside us there. And because of to ensure that we provide adequate support to everybody who's part of the group, we do limit that to 50 members. So we still have some room there. All right, just to give you some insight into some of the events that have already taken place. Obviously, we're in March. of this year, January, we had an economic outlook presentation with an economist. We had a meetup in Denver. In fact, Byron, myself, Mike were all in Denver last weekend, and we hosted a meetup there at a conference that we were all participating in. This just gives you some ideas of what's coming up for the remainder of the year, so you can go through all of those, Michael. Just to give you a sense for when things are happening, and these are some of the meetings and events that, again, we plan for and for the benefit of our mastermind members. So next slide. So I won't go through this, but basically, there are 3 different components we feel like to building wealth, and it starts with making money and finding ways to keep that, and then multiplying that through various types of investments. Next. So these are photos of an asset that we have in Arlington. This is just to give you a sense for why we think multifamily is where it's at. If you go to the next slide, Michael. This is a case study showing you where we've been. We bought this asset for $3.8 million. We've repositioned it and have gotten an appraisal for $4 million more than that, and a preliminary BOV as we prepare to go to market for significantly more than that as well. Where we're at on the next slide, interestingly, we are in the process of closing on an office building here in Central Texas that we may very well do an immediate resale of. And so excited about what that might look like for us. And then the next slide, just to give you a sense of where we're going, we're submitting LOIs, conducting property tours, we're primarily targeting value add multifamily, as I said, but we're also being opportunistic with regards to various things like, office flips, like I just described, or hotel motel conversions to multifamily. So really trying to stay active in terms of things that we're pursuing. Next. And really, this is why you can go through all of these. The one that I want to highlight really is in reference to what we're talking about today, which is crowdfunding. At least that's a term that's used oftentimes to describe what syndication is all about. They're not necessarily interchangeable, but maybe we'll get into that with Byron today. But really, part of why we're pursuing these types of investments is because you can pull funds together in order to take down a bigger deal. And that's really the essence of what our mastermind is all about as well. We feel like individually we can go and do great things, but as a collective, we can do greater things. And so super excited to have Mr. Byron Elliot with us today. If you go to the next slide and see his mugshot yet again. Again, this is just fun facts for today on Friday. Thanks for joining us here. I'll turn it over to Byron. Just for format purposes, he'll go through about a 20-30 minute presentation. We'll open up for Q&A thereafter, and then myself and Michael will actually be monitoring the chat box or the Q&A box. So please do submit questions that you have for Byron there, and we'll field those, and we may toss that to him as he's giving his presentation or save it towards the end, but we'll monitor that as we go through here. So again, thanks for attending. Byron, I will hand it over to you, sir, and make you the presenter. There you go.
Okay, guys, I'm trying to put this guy in presenter mode. Bear with me 1 second. All right. Are you seeing my present screen, Christian? All set. Okay, great. Wonderful. Well, hey, thanks for the opportunity, Christian and Michael. Love the opportunity to reach out and talk on this particular subject.
Hey, Byron, we're seeing your speaker notes, just so you know. You might be able to hide that somehow, just for clarity's sake.
Yeah, sorry.
There we go.
So are you seeing my slide deck now, Christian?
Yes.
Okay, great. Not in presenter mode, just regular mode here.
Yeah, I can see on the right side the large screen, and then I can see the smaller slides on the left.
Right. I'm going to try to put in present mode so you can see I don't think I have small notes, but okay. Are we in business now?
Yes, sir. Perfect.
Wonderful. Okay. So I just want to share a little bit of my background. So as Christian mentioned, our firm really specializes in securities work. We're located about 20 minutes south of Denver, little town called Castle Rock. It's not as little as it used to be. Been doing the private offerings work now for, between 4 and 6 years, depending on where you look as my jump off point. The offerings that we've done are really in the multifamily, self-storage, mobile home park, mixed use, all of those asset classes. We feel pretty comfortable getting around just about any asset class. Me personally, retired Army, retired in 2019. So far in the last 4 years, I think we've helped investors raise roughly $550 million in capital. Again, primarily in real estate. So that's kind of our sweet spot. Met Michael through our Army Reserve unit. I actually recruited him to our unit, and we've been acquainted now for, 12 years or so. And then had the opportunity to meet Christian through him. So what we're looking at today is going to give you kind of some high level stuff on how to raise money if you're looking to syndicate a deal, or if you're even looking to pull together some investment money from friends and family. At what point that becomes a security, and then you're operating in the realm of the Securities Act. So we're going to talk high level about that. We'll get into a little bit more detail when we talk about funds, and I think we're going to leave it open for some Q&A at the end. So the goal here is just to highlight potential red flags and some things to consider if you in fact want to raise money for a real estate deal. Okay. So obligatory legal speak, not legal advice. Part of that is questions that you have are typically fact specific. So what we're going to present today really applies to everything, but I wouldn't take anything from this brief and make a legal decision based on that. If you have a question, maybe we can Q&A after the fact or talk offline. And then this doesn't create an attorney-client relationship. And I know it sounds silly, but there's a reason I have to include this in any briefings that we give. So again, here's we're going to talk about the various laws and then the registration and notification requirements for each type of exemption. We'll talk about that a little bit more here in a second. So we'll kick off with here are the relevant acts that we're looking at. I mean, generally speaking, people who raise money to invest in a property or a portfolio of properties, so you're going to actually take title to the property, whether it's through a special purpose entity that you stand up, a multi-member LLC or single member LLC. Most of the time, you're really dealing with the Securities Act of 1933. When you take a look at getting into the various fund structures, and in some cases, if you as a fund manager are making decisions on behalf of the company as to where to deploy investment capital, you could be in the realm of the Investment Advisors Act. But we're going to talk about a couple vignettes of where you are and where you aren't in the ambit of each of these securities laws. So the Securities Act of 1933, as you can imagine, this came on the heels of the Great Depression. And so by and large, as a matter of public policy, really looking to protect investors from snake oil salesmen, right? Ponzi schemes and things of that nature. And so when they enacted the law, provided quite a bit of oversight on people who are trying to raise money, either in the context of public offerings, but also private offerings. So kind of a securities overview. And this same construct applies if you're dealing with what people try to characterize routinely as a joint venture. And so generally speaking, if you're putting together an offering, what you're doing is you're forming a company. And that company is going to either purchase a piece of real estate, purchase a portfolio of properties. In some cases, you may be buying an interest in another offering. You may pulling together a debt fund where you're going to raise money and then loan money out on certain terms that are advantageous to your investors. But at the end of the day, at any point in time, if you are raising money from investors and they are completely passive in nature, they're basically handing dollars over to you, and the expectation is that they're going to make a return based solely on your efforts, you're generally talking about a security there. And that's what brings you into this realm of the Securities Act. And so what we see is kind of a natural, typical progression is somebody who wants to invest in real estate, they've either moved from their primary residence and they're going to rent out their primary residence as an investment property, or they're going to purchase a single family home and turn it into an Airbnb, and that's going to be an investment property for them. Or they buy a winter home up in Winter Park, but they're going to rent it out 9 months out of the year and enjoy it on occasion. So that's typical first time investment. Ultimately, what we find is people will outgrow their balance sheet. And so this is where you bring other parties onto your team. Generally speaking, you may bring on another partner or two, and they're bringing capital to the table. But in the context of a joint venture, each party is actually contributing something beyond just capital. So there's capital plus some other significant activity. This still keeps you out of the realm of the Securities Act. So you'll do a joint venture or two, and then again, your balance sheets will culminate if you want to continue to scale and grow your business. And this is typically where syndication comes into play. And so what you'll take a look at is an asset that's, more than you would be able to purchase through your joint venture or by yourself. You determine how much money you need to raise, both to purchase the property and then maybe any CapEx expenditures, any, operating reserve that you need, any additional fees and whatnot. Raise money from passive investors. And when you do that, generally the way that works is you form an entity that's taking title to the property or properties, and then you're selling an ownership interest in that LLC or that limited liability partnership. So when you get into the realm of doing that, selling off interests, and your investors are completely passive in nature, now you're dealing with securities. And so what we generally do, and this is probably 95% of our business, is we help sponsors pull together what's called an exempt offering. So the Securities Act allows for a couple different ways to raise money through an exemption, which basically means you don't have to register with the SEC as if you were a stock, bond, mutual fund. But in order to do so, there are certain rules that apply depending on which exemption that you're looking for. And so we have 3 identified here. I'm going to speak to kind of the nuances of each before we proceed. So a 506B offering, this allows you to raise money from an unlimited amount of accredited investors. So accredited investors have a net worth of $1 million or more, minus the value of their primary residence or the equity in their primary residence. Or you can qualify as an accredited investor based on compensation. So if you're married, if you've made $300,000 2 of the last 3 years and a reasonable expectation to do so again this year, you would be considered an accredited investor. Or if you're single, $200,000 the last 2 years and a reasonable expectation to make the same amount of money this coming year. That's generally how people are screening out accredited investors. There's a couple other definitions, but I don't think we need to get into those for brevity's sake here. In addition to an unlimited amount of accredited investors, you can bring into your offering up to 35 non-accredited investors, but they have to show a certain level of sophistication. I'm going to talk about that here in a second. The one limitation on the 506B offering is you can't put this offering on Facebook. You can't put it on LinkedIn. So you can't openly solicit in this offering. It's really close hold to people with which you have a pre-existing substantial relationship. On 506C offering, you are using only accredited investors, but you can openly solicit. And so this is what you'll see on occasion. People are sending you emails, you're seeing LinkedIn notifications of various private equity companies that are out there making raises. Generally speaking, that's a 506C offering, and they can do that. They can openly solicit to sell interests in their offering. And then I have 504 here. I would tell you 504 is rarely used. The reason being is your 506B and 506C offerings both exempt state law or trump state law. So you don't have to be concerned about the various securities regulating agencies and the rules in each individual state if you're using a 506B or a 506C. 504 used to be in play a little bit more, but with the relaxed nature of the other two offerings, I have rarely seen a 504 offering used, and I don't really want to spend too much time on that.
Byron, before you continue, because I think this is such a great and important point, we have seen, unfortunately, some people who either didn't get the requisite advice or maybe chose to go against it when shopping their offering, despite it being a 506B, will put it out on blast on Facebook. And obviously that's a no-go, but maybe speak to sort of the implications, and maybe you intended to do that, but it just came to mind as you were describing those and what the limitations are, and just what potentially could happen as a result of that.
Yeah, so at the end of the day, you know, any consequence that happens, generally it comes from a disgruntled investor, right? That's how this plays out, is if at the end of the day, because, you know, all of these alternative investments are great, the returns are really good, but on occasion you have something that tanks, right? And so the most common scenario is, you know, somebody's lost their investment, and what they're going to try to do is peel back your exemption here. What they may do is say, you know, I didn't have a pre-existing relationship with Byron prior to his offering, and he allowed me to invest anyway, right? So what ensues? It really takes three forms. There's investigative powers at the state level. So somebody may file a complaint, you know, at the investigative agency at the state level, at which point they may look into your offering documents, take a look at the timing of when you met that investor, what the relationship looks like. Did the investor have the opportunity to ask the questions? And then, yeah, they may take a look at it. How did you conduct your offering? If you did put it on Facebook beyond friends and family and made it public, or you put it on LinkedIn, you know, they may unwind your deal. The other piece is if you're found to have done that intentionally, the SEC has what's called a bad actor qualification. And so effectively, if you're found to have been a bad actor, whether it be at the state securities agency level or at the SEC level, if they choose to investigate, your chances of participating in the offering moving forward, especially on the sponsor side, are pretty much done.
Got it. Thank you.
So here's something that comes up, and I'm just going to highlight a couple things here. So what is a security? So much like most laws, there'll be a very, very broad definition, and they carve out exemptions here. Two things that I want to highlight to kind of expand on this definition. So we say the term security means any note. So they say any note, but there's a couple of exceptions that they've carved out. One is a promissory note that matures in 9 months or less, generally speaking, wouldn't be considered a security. A promissory note that is collateralized by a mortgage generally isn't considered a security. So I'm going to give a couple of examples here. A debt fund, right? So it's very common right now. People are raising money in a debt fund. So, you know, they'll raise $5 million. Well, they'll have people wiring their monies in tranches as the lending opportunity becomes available. For a company that's taking a second position in a fractionalized deed of trust, and that note matures in 9 months, maybe subject to a 3-month extension for 1 point, something along those lines. If it's collateralized and the original note is 9 months or less, I would feel pretty comfortable saying that's not a security. And so that debt fund, and we'll get into this, the investment company side of the house here in a minute. On the other hand, and we'll use the redeem fund as an example. And so Christian had mentioned on the front of the presentation that one of their deals they have is they have an energy efficient developer who has funding needs. And so they raise money in this fund and they loan money to that developer for short-term bridge debt. They enjoy a pretty good interest rate and some points here and there. But because it's a note that is collateralized, in this case by a power purchase agreement as opposed to a fractionalized deed of trust, I would probably consider that a security. And so I think the way they set their offering up is the appropriate way to do so. Investment contracts, and we'll talk about that in a second. So just earlier on, I was talking about setting up a special purpose entity to buy a piece of property or invest in a portfolio of properties or whatever else it may be. An investment contract is basically that. It's basically you're forming an entity and selling off a passive interest to either members of an LLC or limited partners in a limited partnership who have little to no say and little to no discretion. So limited voting rights, limited abilities to make decisions as to the day-to-day business or even the purchasing powers of the managers of the company. You take a look at these things to determine what is the level of active participation. And the holding law is this Howey test. So you take a look at the Howey test to determine if there's an investment contract and then therefore a security. So is a third party giving you money? Generally, yes, right? In a common enterprise, of course, they're buying interest in a company that has a particular purpose. Reasonable expectation of profits, I mean, I would hope so. And then derived solely through the efforts of others. And so where this really comes into play that I'm seeing as we're talking about co-GPs and co-sponsors and this and that, this number 4 here on the Howey test, I always take a look at what is the level of participation with the investors. And this applies to your joint venture contracts as well. We see a lot of guys who have pulled together a joint venture and they've got 5 family members and they each put in 50 grand and the 6th family member is going to be the sweat equity guy to run the business, right? Those are securities that are being sold. And it's pretty common, Christian, to your point, these kind of arrangements happen before people scale and grow into larger deals. But just be mindful that looking at the level of activity by that passive investor is really, really important. So the exemptions of registration are from registration. We talked about this briefly, the 506B and 506C, and I would disregard 504. The practical effect of this is instead of trying to register with the SEC or having to register with the SEC, just like a stock bond or mutual fund, the only obligation here under these exempt offerings is to file what's called a Form D. And so basically Form D is you run this through the SEC EDGAR application program. The Form D basically just lays out what does your offering look like? What's the minimum amount you're raising? What's the maximum amount? Excuse me, is it 506B? Is it 506C? Who are the principals? In what capacity are they serving? What fees are you taking as the sponsor of the deal? So all of the details that go into your offering documents are then translated to a Form D for the SEC. It's a no charge to file a Form D. There's no cost associated with that. The second piece is you do have to account for the money that you raise and in what jurisdictions. And so you have to file what's called blue sky filing fees on a state-by-state basis. Not all states require them. Not all states actually charge something, but they may want to be notified that you're pooling investor money from their jurisdiction. So in an offering, you do have to account for these potential fees. And this is all open source. You can look it up, Blue Sky filing fees by state. And it'll show you, New York's expensive. I think California is expensive. Some states don't require them at all, like I said. Others are pretty reasonable. But you just want to be mindful of that as you're working that into your offering budget. But if you do that and you prepare your documents without any material misrepresentations or omissions, do your filings like you're supposed to, and as long as you don't have disgruntled investors, you should be just fine. We talked about this already, but I want to talk a second here about
Byron, let me interrupt real quick, please, before you continue. So, with regards to Blue Sky filings and really state registrations in general, there's a timeline by which those filings need to be completed, right? And so, what happens if you exceed that timeline? Are there penalties involved, or maybe describe that a little bit?
Yeah, so good. Thanks for circling back on that. Okay, so our obligation is to file the Form D and your Blue Skies within 15 days of receiving money. I would caution, one of the challenges that we have and other sponsors have is there's a two-part process to registering with Edgar, which is the name of the system, very antiquated system that SEC uses. So the first step is you have to get a power of attorney from the sponsor, or if you're the sponsor, you can do it on your own behalf. You file what's called an Edgar application. Sometimes it takes 2 or 3 days to file this thing, depending on what browser you're using, what cookies are enabled, what aren't. It's a really antiquated system, but assuming your Edgar application goes in day one, ideally they review it and approve your Edgar application, which produces a series of codes. Once you start raising money, you would let your attorney know, or if you're submitting this stuff on your own behalf, you go in and file the Form D within 15 days of taking your first subscription. And then same thing on a weekly basis as you continue to raise capital, you'll go in and file your Form Ds, depending on what state you're raising in, how much, and then you have to know as the individual, are they accredited or not accredited investor. In some states, it's not even required. They may not even have an obligation to file a Blue Sky. In other states, it is required. In some states, if you're late, there's a late fee associated with it. In other states, you're late and you can't cure it. That's just a mark on your record, so to speak. There is no punitive action associated with that. But they do acknowledge that you've paid the Blue Skies, you've just been late in doing so. So those are the most kind of severe examples that we've come up with. We did have one example where the client didn't update their tracker for 2 weeks, and so there were 2 subscriptions that were a little bit late getting to the state of Nebraska. And so we had to go back and list out the reasons why these were late. And basically what happened was they had turnover in their offering into the principals in their offering. The person who was responsible for tracking the money and submitted it actually turned over and was no longer participating in that company. And so we had to spell that out in a memo, sign it and send it off, and we were able to rectify that with no late fees.
Got it. Okay, thank you.
What I've got on the screen here is we talked about accredited investors. And really, I just talked a little bit about retail investors. So the natural persons, the net worth test, the compensation test. There are a couple other examples here. And so this is important if you're a non-accredited investor, but you're trying to pull together an offering. If you are one of the principals or the knowledgeable employees of that offering, then you can be a non-accredited investor, but get the accredited status for the sake of that offering. So that kind of comes into play twice. One, if you're doing a 506B, that saves a couple spots on that 35 non-accredited investor roster if a handful of non-accredited investors are actually principals in your offering or knowledgeable employees. The 506C offering obviously lets that investor get into an offering they wouldn't be able to get into otherwise because of their accreditation status. I'm going to move on here, Christian, but I'll leave the deck for you guys. I want to go back and review the entity side of the house, but for the sake of brevity, I'm going to move forward.
Byron, if you can go back one, I think there wasn't there a recent change whereby I think professionals within the financial space could qualify as an accredited investor, even if they couldn't do so from a financial perspective. But I could just find out something new that happened within the last year or two.
Yeah, so they've given the various certifications, the security certifications. If you've passed, I think it's a series 66, 67. There's a handful of other ones. If you pass those, then the SEC will allow you to be characterized as an accredited investor. Obviously, the presumption is you're educated enough to make an informed decision.
Okay.
So here's something I just want to highlight. We talked about the 506B offering, but here are some limitations, right? So we talked about the pre-existing relationship. So if you're pulling a deal together, you haven't finalized your documents, you haven't finalized your pitch deck, your operating agreements and everything, but you have anticipation of having a deal in the next month or so. You have from the time you decided to go under contract and purchase this property until the time you make this publishing, until you publish this offering, right? You can go out and establish these relationships. And what does it mean? Pre-existing, substantive. Neither one of these are clearly defined by the SEC. So pre-existing in my mind could be as simple as I met Christian and Michael on day one of the Best Ever Conference. We had lunch. We followed it up with happy hour. We got to know about each other's businesses, each other's backgrounds, each other's level of education. And they're basically screening me as a potential investor. The conference lasts 2 more days. We have, lunch or dinner again, maybe a follow-on phone call after the offering. To me, that would meet the requirement of a pre-existing and substantive relationship, because you've gone just, beyond, the superficial, get to know each other. You actually know each other, you know about each other's business, about your level of sophistication. That's where you feel comfortable. Where I don't feel comfortable is sometimes people will hire a call center and call prospective investors on behalf of a sponsor. And they'll mark that down as if that's when they met the individual. They've never had a substantive phone call. They've never met face-to-face. They've never, ascertained that person's level of sophistication. To me, that's dicey. Get into that a little bit more here.
Well, if I want to add on to that real quick, Byron, if you don't mind, because for people who are seriously considering going down this path of raising capital from amongst different people, I can tell you it can become very tempting when you have a shortfall in your capital raise and there are other people who have the means and have expressed the desire, and meanwhile you technically can't accept their offer. Just case in point, our very first deal, which was in Houston, there was a point in time when I was raising capital for that where there was probably another 100 to 200,000 that I needed to raise, and I came across this personal injury attorney who had 300,000 that he was looking to deploy, but my offering had already launched, and because I didn't have a pre-existing relationship with him prior to the offering date, I could not accept his money. And so I had to tell him, no, unfortunately, I can't, but I'd love to keep you in our database. So that's just sort of anecdotally how this kind of comes to light for those who are interested in moving down this path. That this is super important.
Yeah, and so, I have a lot of clients that are trying to figure this out. Same sort of thing. They know that they can raise a limited amount of capital, but they want to know, in terms of time and space, where do I start establishing relationships? Do I wait until I'm in the midst of a capital raise, or do I participate in activities that help me start to develop these relationships? And so this mastermind is a great example, right? You should feel very comfortable if you have the opportunity to meet multiple people in this mastermind group. You're starting to ascertain their level of sophistication, right? You have the opportunity to talk offline. These are the kind of activity that you can do between now and actually setting up an offering and start to build a prospective investor database before you find something that you want to move on. So again, the SEC attempts to define this a little bit, but then backs out in terms of there is no specific duration of time or particular short form accreditation questionnaire. I'm going to share with you a questionnaire here in a second that helps. One of the benefits of the 506B offering is the investor can actually verify themselves their own accreditation or non-accreditation status. So what that basically looks like is a questionnaire that says, do you meet any of these accredited investor requirements, right? And that's a yes or no. If it's yes, they'll check the box. Okay, this is my net worth is more than $1 million. End of story. If they don't meet the accredited investor requirement, then the onus is on you as the sponsor or the operator to determine that person's level of sophistication. So what does that look like? That's more of kind of a factor by factor analysis. And we'll get into that here in a second. I'll show you kind of a breakdown. But basically, you're looking at that person's level of education, right? You're looking at their level of experience in investing. Generally, you're looking at their level of experience in investing in real estate. You're looking at their life experience. These are all things that you want to know about the individual. And this kind of meets the substantive relationship requirement, but also lets you determine their level of sophistication. So let me give you an example of a couple different types of investors. You may have somebody who easily meets the accredited investor requirement, right? Doctors, dentists, lawyers, high net worth, W-2 income earners, tech types, right? So they're very good in their particular field, but they may not have a clue about investing or investing in real estate. On the other hand, you may have somebody who graduated high school, went to work in construction trades, ended up getting a real estate license or general contractor license, and has more experience in the industry generally than the same doctors, lawyers, and dentists. So this 35 sophisticated investor opportunity is really for those types, people that are intelligent enough to understand the offering and kind of do their own underwriting. You should feel comfortable allowing them into your deal as a sophisticated investor. But you have to at least ask the questions as to their level of sophistication. So in terms of timing, right, this is a big question because people are trying to Christian's point, if tempted, may try to skirt this offer, right? When does the offer start? Because as soon as the offer starts, you're not developing pre-existing substantive relationships. That opportunity is kind of passed, right? So really we equate this with you have a pitch deck and you're putting in financial information or forward-looking statements. You've got a PPM and an op agreement, and you've got those all dated on a certain date, and you're publishing and pushing those out. That's typically the offering. So this begs a good question, and I've had this discussion multiple times, is what do I do to prime the pump before I actually make the offering public? And, what can I do to not condition the market, right? And so one example would be having a webinar that talks about you as a company, or a podcast about you as an individual and your company and what you do. This is what we do. You're not going to talk about specific deals. You're not going to talk about return metrics. You're certainly not going to talk about the upcoming deal and what you think those metrics look like, unless you're just going to do a 506C offering and call it a day. Right. But if you're going to do a 506B offering, which is very common for the first 1, 2, 3 syndications that people do, you can prime the pump, so to speak, talking about your company, talking about your experience, talking about the market that you're looking at, talking about the asset class, right? These are all things that you can do in your introductions with potential investors, and then develop that substantive relationship before you go public with your offerings. Once you do that, that's it. That makes sense?
No, that's exactly right. Exactly right.
Okay, so we talked about the sophistication factors. I'm just going to share a practical tip. We have a standard form, like a Word document or a PDF, that kind of lays out what we showed what an accredited investor was, where the investor checks yes or no. And then I have in my own form-based document. So I do a web-based form document, either form site, Office 365 forms, Google Forms, whatever it may be. You can generate a questionnaire like that that has all those same questions. And then I tack on additional questions at the end that ask, what is your level of education? Do you have any special certifications? You know, going back to the series, 66, 67, whatever. What's your investment experience? What's your real estate investment experience? And then what I'll ask is some follow-on questions that will let me know what type of investment objective that person has, because you have different types of investors, right? You got some guys who they want to plunk in 50K and they expect their preferred return year one, right? Quarter one, year one. And so they want returns immediately. On the other hand, you got people investing with a retirement account and they may not need that money for another 5, 10, 15 years. So they're a little bit more patient about the growth of that particular investment. So, in these value add and opportunistic deals, sometimes it may take 2, 3 years to start getting returns from operations. So you want to know what type of investment objectives these people have. Ask about asset classes. What kind of asset classes they like? This allows you to build that investor database, and then when an opportunity does present itself, it's easy to kind of sort through. This person is interested in multifamily only in this market, right? Those are the kind of things that investor database allows you to do. So when an opportunity does present itself, you can, sift through that pretty quickly. So establishing the pre-existing relationship, right? This is certainly, you want to know the date of the first meeting. You may have some notes. So if you have a basic CRM, maybe that's helpful. If not, again, I like to use the form-based stuff. And what I'll actually do, another question that I'll put on is, who do you know out of the principals of who's making the offering? Do you know Christian? Do you know Michael? Do you know Peter? And if so, how long have you known them and where did you meet? And what's happening there then is that prospective investor is actually doing the data entry for you and is showing or validating that they do have a pre-existing relationship with your company or one of the principals. That's pretty powerful. So this is an example tracker. So at the end of the day, you have people filling out this form-based questionnaire. You can export most of the time with these. Take this, hand this off to your investor relations person, and you know who you have this pre-existing relationship with prior to the publish of the offering. Okay, so what's required when we're dealing with securities? You've probably heard the term PPM, private placement memorandum. If you haven't, it's very similar to a prospectus that you would pick up from a financial advisor on a stock, bond, or mutual fund. The PPM is the most involved document. This is the one that conveys to the investor everything that they need to know to make an informed decision. And so some of these are fairly straightforward. The big things that we take a look at least from a legal perspective, are the risk factors. And so risk factors, the way we approach these on the firm side of the house is we'll look big picture in whatever industry you're operating in. So we have a handful of real estate specific risk factors, right? Then we'll narrow down into the asset class and the geographical location of the investment. So by way of example, there's people that invest in Texas RV parks, right? Most of the time, those RV parks are highly dependent on the oil and gas industry and how they're performing at a certain point in time, right? And so you would disclose that this RV park, while it's at occupancy, 100% occupancy now, the reality is if there's some change in the atmospherics regarding oil and gas, there's a chance that we could operate at less than 50% capacity. And those are the things that you have to highlight for an investor. Sources and uses. So for each dollar that's in your capital stack, you'll identify what the debt component is, what the equity raise is, and then where that money is going to go, the uses side of the house. Right, we're going to put 30% down on this property. We have these pre-development soft costs that we're going to have to pay out of pocket. And then there's a handful of fees that we as the sponsor will be entitled to. And so you have to disclose where the money's coming from and where the money's going. You identify who the principals are. Generally speaking, you have somebody who's a CEO type who's spinning all the plates. You got an ops person, you got an investor relations person, and maybe you have a CFO type, right? And so you'll want to show in your offering documents, these are all the capabilities that we have, either internal to our team, or if you're shoring up a shortfall, like maybe nobody has a construction background, then you show who's that third-party provider who's going to serve as your construction management rep or your owner's rep on the architect side of the house, right? So you're going to shore up any shortfalls that you have in terms of the leadership team. So there's some other requirements here. I would tell you this first one doesn't typically apply, the audited financial statements. The reason being is for most of the offerings that we do, we actually stand up a brand new entity. That entity is going to be called the issuer or the sponsor. And so providing audited financial statements, we have a reasonable requirement to do so. But if it's a brand new entity, there are no financials to speak of. Ongoing informational requirements, you guys will decide as the sponsor or the operator what you want to obligate yourself to do in terms of providing information. So hey guys, I've got Stu and Goody in the office this morning.
Hey guys.
What's up? What's up? Is this a bunch of Army dudes?
Mr. Byron Elliot's teaching us a little bit about securities law.
Yeah, when we walked in, I could tell it was Army. We felt it's not as smart. So we're gonna go back to Katie's up part of the office. See you guys.
They've got jokes. Love it.
Sorry guys, those are my Skill Bridge interns that never show up to the office.
Very nice. No, it's good. Send a couple this way. We need some.
Yeah, so here's something you want to take a hard look at is the informational requirements, right? So you're striking a balance between what the investors would expect for updates on their investment and what you can reasonably provide to them at short notice, right? I mean, it's time intensive to pull together the various reports and updates and this and that. So just be mindful of that. Then we talked about the Form D filings and the blue skies. So little pros and cons of each. I'm going to push through this, Christian. I think we've talked most of these parts.
Yeah, I think we're good on this.
Only want to highlight here is, these are the things that are pretty important. The material misstatements or omissions. And so you'll see people out there, even big players in the game. If they're putting out forward-looking statements that just aren't grounded in reality. I think one example is, I think it was Grant Cardone. He put out an offering where he basically promised, which you never do, promised that he would double that investment in 12 months, right? It was one of these fun deals, and he just didn't. It was all inflated, and so he's under scrutiny from the SEC right now. A little bit of additional background. You talked about potential consequences. I'm going to let you guys review this on your own. I really want to get into the 40s Acts. And like I mentioned at the beginning, the only time that we really get into these two acts is when you're getting away from investing in real estate. So this is a really popular concept right now, this fund of fund models. Where this comes into play is if somebody, let's say Byron, has the ability to raise capital. And I know that I have an investor network of 100 investors. If I had to pull together $2 million, I could do so, but I don't have the ability to operate a real estate investment. I have the ability to raise capital. So what I may do is I find somebody out there who has an offering who's really good at what they do. So let's say, the Redeem Renewable Energy guys. I like what they're doing. I want to invest in what they have. I want it to be fairly hands-off for me. So what I would do is actually pull together my own special purpose vehicle, an LLC or an LP. I would raise that $2 million in capital, and then I would invest it in another sponsor's deal. So if I invest one in the renewable energy fund, and I take the other monies and I invest that in another sponsor's deal, I'm effectively investing in securities here. And so what I have to be mindful of is if I raise this money in my fund, the less discretion the investor has to make a decision about where their money is ultimately deployed, and the more reliant they are on me to make that decision for them, that's where I'm getting into the investment advisor side of the house, right? And then if I'm creating a fund or making an offering that's investing in other securities, that absolutely brings me in the realm of the Investment Company Act. So now I'm dealing with two more securities acts. You can navigate this. It's not problematic until you get to be a little bit bigger fund. So the Investment Company Act, there's a couple exemptions from registration there. So our first exemption from registration was the vehicle to raise money, 506B or 506C. Now we've raised the money and we're going to invest in securities. We've effectively formed an investment company, right? However, if you use the 3C1 exemption, basically you use 99 or less accredited investors, you can do this without having to register with the SEC as an investment company. Or you can use a 3C7 exemption, unlimited amount of investors, but they all have to be qualified purchasers. So they have to have a higher net worth test. So when you get into investing in a fund that's buying other securities, here you have no opportunity to use 506B non-accredited investors. You're using, at a minimum, accredited investors only. That makes sense?
Yeah, no, I get that. And really, I think in the interest of time, we'll probably seek to try to close here soon, but I do want to pose a question that came in. I think what you're talking about here is really good, especially for those who may have done a standard syndication and then are thinking about what does it look like to do a fund downstream. And so this is really going to be important information for that. The question that came in is really in line with a question that I had, but I'm going to try to combine a couple of different other questions and allow you to answer this, Byron. So really, well, one is, if someone were interested in raising capital and doing it the right way, how would they go about engaging with you, and what is it they can expect from the service that your firm provides? And then secondary to that is, what if somehow, either because they've done a syndication before and have the standard documents already, or have obtained those somewhere else, can they simply use those documents, recycle them, and maybe allow your firm to review it? How do you want to address that?
Sure. Okay. So in terms of working with us, and this will be pretty standard, nuts and bolts of working with a firm for an offering. Basically, you'll take a look at what exactly do you need accomplished? Are you looking to do a syndication on a single deal? Are you looking to raise money for a fund that will invest in somebody else's deal? Or are you looking to raise money for a fund and there you're going to buy your own properties with that fund, right? That helps determine the complexity of your offering. And we're very transparent about what we charge. The process is the same. We're going to work with you from the time you have an LOI and you know if there's a property you want to purchase. We're going to take a look at the LOI. We'll take a look at the PSA. Depending on the jurisdiction you're in, you either have an agent or a broker help walk you through to close on the contract, or you would have our firm or another legal firm help you with that as well, right? Where we really make our money is drafting the PPM, drafting the operating agreement or partnership agreement, depending on the type of entity you choose, the subscription agreement, the joint agreement. Both of those would be signed by the investor. One saying they've read the materials and understand, have made an informed decision. I have the opportunity to ask questions of the sponsor. The joint agreement basically says I've read the operating agreement or the partnership agreement and I agree to be bound by the terms. So we do each of those documents, we review pitch deck materials, and then we file the Form D, and then on a weekly basis, as long as you're updating us with where your investor money is coming from, we file the blue sky filings for you. The client's typically responsible for the blue sky filings, just the dollar amount associated with the fee on a state-by-state basis, but we perform the action for you. In terms of using other people's docs or reviewing docs, you'll see a lot of PPMs will look very similar, right? I'll grant you that. A lot of it is boilerplate in terms of what has to go into the documents. But where it differs on an offering by offering basis is really getting into the nitty gritty on the risk factors, making sure that the waterfall sources and uses and the sponsor fee schedule are accurate and that they make sense based on the type of project. So that's where, a firm really makes their money is working on those things, and then making sure that the documents themselves are updated on a routine basis. As the SEC promulgates a new rule, making sure that the document itself comports with, the information requirements. Where it gets challenging in terms of using other people's documents is, one, our documents, we feel comfortable with them, right? Because we constantly review them almost on a weekly basis. Two, it's our malpractice. So something happens, an investor sues, or something doesn't go right in the offering, and it's as a result of poor drafting and the legal work that's been done. You have a remedy when you work through a firm, right? That's my malpractice insurance. And so securities laws is very highly litigated, highly regulated. Unfortunately, as a result, the malpractice insurance for practicing attorneys that are putting documents together is relatively high compared to somebody who's working in another practice area. And so I think you'll find that, I know our firm is very reluctant to use other documents, and I know a lot of other firms are very reluctant to do that as well, simply because a PPM is a 45-page document. If you want an attorney to go through and review a 45-page document, a lot of times they'll charge $35 to $50 per page. And so at the end of the day, you're probably spending more for somebody to review, redline, and rewrite the offering documents to their level of comfort than you were if you just engaged that attorney on the front end. I'll give one example where I agreed to actually review documents, and that's because the guy who drafted them was a 25-year attorney out of Cornell who had done multiple offerings on the LP side of the house and on the sponsor side of the house as part of inside counsel, right, for a sponsor. But even he, at the end of the day, he had errors in terms of what type of offering, what type of investors. It was short on the sources and uses. The risk factors were about a third of what they should have been otherwise. And then the operating agreement wasn't nested with their PPM or the projects in which they were investing. And so there's a synchronization across all of these documents to make sure that they're all consistent and that they meet what the business plan calls for. And I built you a watch there, but I hope that answered the question.
I think it does. I mean, from my perspective, I've come to the point where I would prefer to pay professionals to do what professionals do. And sure, you can download something off of Google, but at the end of the day, what the value of the advice that you're getting and the guidance is priceless, I think. And so I wouldn't shortchange the process by simply downloading a set of documents and hoping that I can pay an attorney the cheapest amount possible to review those documents. So yeah, I think it's definitely worth it to go the right way.
Yeah, and a lot of the concern is about the price, right? It's not cheap to pull an offering together, but at the end of the day, 9 times out of 10 or more will build the ability to recoup that cost into the private equity raise. And so the sponsor, yeah, you've got some risk on the front end, right, to pull stuff together, and then a deal may not go through. And so yeah, you're stuck there with that legal bill then. Whereas if you have a deal that goes through, we wicker in an acquisition fee or a buy line item expense reimbursement where you can actually take proceeds from the offering and pay back that expense.
So on that note, maybe we seek to, again, land the plane at this point, Byron, given the time, but can you speak to sort of what the standard range of costs look like? Maybe not exactly for your firm, but just in general for sourcing the types of documents that would be necessary to produce an offering?
Yeah. So on the lower end, what you'll see is an offering that is for the purchase of an individual property, or let's say a portfolio of 1, 2, 3 properties, right? The reason that's less expensive is, one, there's less risk, both on our firm side of the house, but for the sponsor, because the investor has the ability to not only rely on the sponsor's information about that property or those properties, but they can do their own due diligence, right? They can go compare market rates for improved rents, or they can take a look at comps in the local area. So they have the ability to look at a discrete property or, portfolio of properties, less risk associated with that. When you get into a fund of fund structure, so what we have here on the screen, gets a little bit more expensive, but if these 2 funds that you're investing in, you identify those at the offering. So there's 2 deals that you want to participate in. And you can clearly identify, in this one fund, I'm going to invest in Redeem Renewable Energy. And in this other fund, I'm going to invest in the Redeem Commercial Real Estate Fund. Well, you can get very specific in your offering documents there. The PPM is going to describe those 2 funds that you're investing in and disclose everything about those, to include the principals and everything goes. So again, less discretion for the sponsor to just place money wherever they see fit. They're tethered to investing in those 2 funds specifically. Those 2 type of deals, I think you'll find the cost range anywhere between $9,000 and $25,000, depending on who it is.
Yeah, and actually that's probably on the lower end of what I've seen or heard. I mean, some of these offerings that are a lot more complex can get up into the $100,000 range. I'm hearing, which obviously we've not done anything of that size and scope, but I'm just in disbelief. But yeah, no, that's good to hear. Thanks for that range there. So Byron, if folks want to get a hold of you, what's the best way to do that?
Yeah, so my email address is simple. It's byron@3pillarslaw.com. I think we're the only 3 Pillars legal firm in the country that I know of. So you type in 3 Pillars Law, maybe Colorado, you'll see our website. And our office number is 303-284-3850. But email's great. And if anybody wants to learn more, happy to continue this discussion. Sorry I ran a little bit long.
You're fine. Any last or final words for the group before we shut down here?
Yeah, I think before you embark on dealing with other people's money, don't be afraid to reach out to speak to an attorney. And I'll make myself a resource to your group. I don't charge consult fees. You got an idea and you got a project and you want to know if you're over here in the Securities Act side of the house, or you're still over here in joint venture land, or you want to know what opportunities you have to use other people's money, just give us a call, give me a buzz. I'd be happy to chat through some of the mechanics.
Yeah, well, you heard it here first, folks. I think that there are other attorneys that will charge for consulting fees. Obviously, these guys are on a billable hours sort of schedule and time frame, and their time is valuable and can be costly. And so for those who are listening in and get to watch this, Byron is making himself available for free of charge for consulting on a consulting basis. And hopefully you'll find that in talking with him that he can provide you with extreme amount of value and that you can find work to do together. So with that, Byron, let me say thank you so much to you. Really appreciate your time and your expertise. It's super important for folks who are aspiring to do some of the things that we're doing and have done, to be able to learn and engage with people who are experts in their space. And so you're certainly that, and we really appreciate your support for our group. So thank you again. Yeah, really appreciate the opportunity. I apologize, I've lost my voice a little bit. So hopefully it wasn't too rough on you guys. No, you're fine. And for everybody who joined, thank you again so much. Should you need anything from me or from our team, contact us at info@redeeminvestments.com or go to our website and we'll get you all plugged in there. So thanks for everybody joining. Take care and God bless you.